Money is being printed, interest rates cut, billions invested to try and stop the global economy from imploding because of coronavirus. But the measures announced by central banks and governments have done little to stop the slide in share prices. So, what next? This is Roundtable. More than $1 trillion is being spent on emergency measures to prop up businesses around the world as the global economy reels from the effects of coronavirus. It's a shock that could dwarf the recession of 2008. So what more can be done?
The coronavirus outbreak has caused massive disruption to the global economy. Economic experts say we are headed towards a recession worse than the financial crash of 2008. Mainly because this time the flow of goods and services, the real economy, has been hit rather than just the financial markets. Worldwide, the disruption of supply chains, closure of businesses, and layoff of workers may cost the economy up to $2.7 trillion, according to one estimate. But governments have stepped in with emergency stimulus packages, $1.8 trillion in the US and $400 billion in the UK, to support businesses and people affected by coronavirus. They've slashed interest rates to historic lows. The UK government will also pay 80% of the wages of millions of workers who cannot work during the crisis, up to $2,900 a month. But taxpayer support isn't a long-term solution. Economists fear unless a medical solution is found for coronavirus, and soon the global financial meltdown will continue.
Joining us at the Roundtable, all in London, England, are Asad Hamir, who is a technology entrepreneur and founder of Noli. We also have Lukman Otunuga, who is a senior research analyst at FXTM. And Ranko Berich is with us too. He is head of market analysis at Monex Europe. Thank you all very much indeed for being on the programme. So clearly we are in quite unprecedented times at the moment, and economies around the world are struggling. We've had measures being announced from different economies, the US, the UK, others too. Are these stimulus measures working? Let me start with you, Asad. What's your point of view?
So there was lots of headlines last week around all the different stimulus measures. So I have a few different businesses, one of which is in retail. So we've actually had our stores closed yesterday. The challenge, is now letting some of these stimulus things feed in to businesses. So, for example, the business interruption loans, which were widely acclaimed last week, still haven't fed through. So banks, having spoken to banks pretty much every day since, none of them have actually heard about, how it actually works. The same thing happens with the wages protection scheme, which is fantastic in principle, but actually, when you're speaking to accountants, HMRC, no one actually knows how it's actually going to get paid. So the concern is now how we actually get money to the front line for businesses like mine. I mean, I employ about a couple of hundred people across my businesses. And we're, you can't prepare for something like this. It's impossible. Now we're in a position where we're scrambling around. There's constant calls every 10 minutes with landlords, creditors, trying to basically just conserve cash so that we can get through this period, basically. It's very challenging.
And how about you, Lukman Otunuga? What has been your impression of the stimulus measures announced?
Actually, you can actually reflect it across equity markets. The ramifications are seen that the coronavirus is having negative consequences on the global economy. Over 50 central banks across the world have cut interest rates, and governments are unleashing their fiscal time bombs. However, though, stock markets are still in the red. Like in March, for example, we saw that after an 11-year bull run, the S&P 500 came to an end. European stocks had their worst day on record in March. And also, if you look at the FTSE 100, it actually experienced its worst decline since Black Monday in 1987. Traditionally, when we speak about monetary policy, lower interest rates would encourage business investments and encourage households to save less. But when we look at the coronavirus as itself, it's a health crisis. It's not a financial or trade crisis. So nobody is unlikely to really pay attention to lower interest rates when there's a health crisis, in play. So this is what I believe at the moment right now. In regards to the fiscal policies, it could play a role. But if we were to put this into context, just imagine the global economy as a bucket full of water. Now, the coronavirus has put a lot of holes and the global economy is leaking. While monetary policy is proven ineffective, fiscal policy could play a role. However, I believe that the solution to this will be a cure to the coronavirus.
So using that analogy, Ranko Berich, these measures don't necessarily plug those holes. Is that your view?
I think Lukman's correct to say that lower interest rates aren't a cure for the virus. Monetary policy is trying to do two things at the moment, and fiscal policy is trying to basically do the same two things. The first is cushion the blow to the real economy. So that's, as Asad was saying, preventing businesses from having to fire staff, making sure that financially sound businesses have access to credit to basically remain somewhat functional during the shutdown period. So that's the first thing that both fiscal and monetary policy is seeking to do. The second thing that monetary policy is being increasingly desperate to avoid over the past week or so, I would say, is a credit crunch. So a tightening in financial conditions where there's a cascade of effects where businesses go under, financial conditions tighten because banks are afraid to lend to more businesses, and then more businesses go under because they can't get access to credit. So they're two distinct goals at the moment. I think both monetary and fiscal policy will be incapable of preventing global gross domestic product from contracting at a pace that is really unprecedented since the Second World War. That's very clear. The question is what happens after that. I think the scale of the fiscal measures we've seen in the United Kingdom, for example, are likely to mean that when the virus blows over, we'll see, I don't want to say a V-shaped recovery, but hopefully we'll see something like a U-shaped recovery, at least in the United Kingdom. I think the nature of the fiscal policy that's put in places like the US and Europe will also determine the extent to which the shock can be mitigated, if not completely prevented. In terms of preventing a financial crisis, well, I mean, we haven't seen any major insolvencies of financial institutions. However, indices of financial conditions, particularly in the United States, so credit spreads, for example, have continued to widen over the past week. Another indicator of financial conditions, for example, would be volatility in gilt markets in the UK, which is, of course, what caused the Bank of England to freak out, if you will, last week and make their announcements.
Well, let me ask you all a little about quantitative easing, because when people talk about QE, they nickname it printing money. But in this case, what exactly are these measures going to do? Let's drill down into the detail. What are they supposed to be helping, and who will be getting this money?
The idea behind quantitative easing is to take assets and give the people that had those assets cash instead. It's as simple as that. In doing so, you raise the price of those assets, and there is an element of restoring confidence in financial markets. So in a macroeconomic sense, it flattens the yield curve and it encourages more risk-taking from asset and cash allocators. So the goals of quantitative easing are twofold. It's to calm markets, and secondly, to put enough cash in the system such that liquidity concerns of the sort that we've seen in recent weeks are either mitigated or completely prevented.
And Asad, you were going to say?
Yeah, so I mean, from a business perspective, I think the challenge is now is that we're kicking the can down the road when it comes to paying our expenses, our rent, whatever it is. So normally in these kinds of extreme situations, you normally have insurance in place which can cover you, and you can recover any losses from there. But in this situation, taking my business or a retail business, when we're talking like rent holidays and the like, I'm still going to need to pay those costs. So I'm still going to need to pay them later down the line, and not having recovered any revenue made a huge loss in this quarter. So the challenge is, for SMEs is how long this lasts, how long we can last as businesses. I'm now looking at a 3-month cash flow, but I'm also now preparing another one, which is a 6-month cash flow. and it's not looking pretty. And you know, for businesses, that's going to be the big challenge, is how quickly, you know, the Prime Minister yesterday said 3 weeks. I really hope so.
So do you think that the money should be focusing on businesses, maybe larger businesses like potentially the airline industry, clearly something that's struggling in these times, or should it be devolved to consumers? Because clearly consumer spending is a key to keeping the economy moving. What do we think about that? Should it be more widely focused or more individually focused, or something else?
Yeah, just to add to the question of quantitative easing, as Berich said, yes, it's to promote some financial stability, but as we saw yesterday, the Federal Reserve actually detonated what we call a atomic monetary policy bomb by, you know, pledging to do unlimited QE. But we saw the effects across markets. It was a muted reaction, and today only stocks are slightly pushing higher. And it goes back to what we were saying earlier, that even though central banks across the world are doing what they can and, you know, unleashing their monetary policy bazookas and atomic bombs, it still looks like our markets are turning towards fiscal policy. So in the United States, you know, everyone's waiting to see whether the government will be able to move ahead with that 200 trillion fiscal plan to save the US economy.
I just think it needs to be everyone. This is not 2008. You know, the government have said this is a once in 100-year problem. You know, everyone needs support now. It's everyone from the SME to the large business to the small business, and this is where you want government to step in. Everything's connected as well. So if my retail business fails, you know, the retail shop designers, you know, everyone linked to it will fail. You know, or you know, will have an impact of that failure. So I think it's challenging for government, clearly, because, you know, which do you attack first? You know, which is going to be the most in need. But I think government needs to be looking at everyone, and you know, obviously they're on the back foot. You've seen a lot of backlash in the last few days around self-employment, but you know, every area is kind of, you know, needing more and more cash, and I think the government just needs to be much more reactive to this.
There is, of course, the problem, though, that the governments have suggested there will be unlimited funding for people. How on earth is that sustainable? We don't know when an end is going to come. How can they promise money forever, potentially? Ranko Berich, what do you think?
Well, the ultimate constraint on the government's ability to print money is inflation and the value of the currency. So historically, this has been something that past UK governments have worried a lot about. You know, during the Cameron government, George Osborne, for example, was always worried about bond vigilantes dumping sterling and dumping gilts if the UK government debt got out of control. And this narrative is about 40 years old in economic theory, the idea that there is a hard borrowing constraint on what the government can do. We have seen a very significant change in thinking in both the markets and in economic and policy orthodoxy towards fiscal spending over the past 2 years or so. I think the truth is we don't know where the constraints are for how high government borrowing can go and to what extent monetary financing of government spending can really support the economy. But I think it's pretty clear that the limit is a lot higher than what we attempted to do in the aftermath of the 2008 crisis, where we attempted to exclusively use monetary policy, so quantitative easing, low interest rates, to boost growth, and that's proven to be really arguably catastrophically ineffective at doing what it's supposed to do. And I think it's positive on the whole this time that policymakers are looking to fiscal policy as well. So in an old school kind of Keynesian framework, when you are at the zero lower bound of monetary policy, then it's time for the government to step in, raise inflation expectations, and in this case, provide almost like a form of insurance to the whole economy.
And what do you think, Lukman Otunuga? Is it good that it's been unlimited, or are markets worried and businesses?
I think the only major concern here is that this may result in a massive expansion in government debt, especially in the UK, and this could easily dislodge the government's original vision to level up the economy. This is the main question. We don't know how long the coronavirus outbreak is going to last in the United Kingdom or in the world as a general, so there is going to be a limit to this. And it goes back to government debt. You know, if we have a situation where the virus outbreak lasts for 3 to 6 months, that could, you know, actually hit the UK economy in a negative way.
And Asad Hamir, you are a small business owner. Knowing that there could be unlimited funding to pay wages up to, I believe it's 80%, is that reassuring for you, or do you think that's just not enough?
It doesn't go the full way, right? So there's, with the 80% policy, I still need to top up the 20%, which, you know, I'm doing right now, even though we've got no revenues coming through. So it's a question of how long this lasts for. So I still need to pay for all the other costs that I've got in the business, whether it's, you know, inventory, stock, rent, and we're juggling the cash flow as we are right now. But I don't know how long I'll be able to last. So the question then is, like, will the government raise that? How long will they continue to bail out SMEs like me? I mean, before this pandemic, we were a very healthy, profitable business. We were not, you know, at all heading towards a challenge financially, and that's the big issue for the government, is businesses that were financially strong, very creditworthy, are now almost on the verge of bankruptcy. How do you solve that?
I don't know if you were personally in business in 2008 during the trouble at that time. Is this worse for you if you were, or is it comparable?
So I actually started my business in 2008 in the financial crisis. So I started a mobile phone reseller business, which I still have today. And luckily at that time, I had a product which was exploding in terms of the market. Smartphones were, you know, very, you know, they were very hot at that time. So I was lucky. I kept my costs low. I was very risk averse. And I think having been through that crisis has taught me a lot for how we deal with this today. Obviously, we've had, you know, years and years of probably, you know, good business. But now it's, you know, it's bringing back the years, I guess, from back in 2008. I do, you know, I hope we can get through this. Obviously, like, you know, the hope is that following the lockdown period, that, you know, businesses come through this positively and hopefully only last for 3 weeks, like Boris Johnson said. But let's see.
And Ranko Berich, what do you think? Is it worse than the 2008 financial crisis so far, not knowing when the end is yet to be?
Yeah, I mean, obviously we're speaking completely in hypotheticals because we don't know if herd immunity will suddenly kick in 6 months' time, as perhaps the UK government was hoping a few weeks ago. But I think at this point what's clear is that the shock to the real economy, so businesses like Asad's, unemployment, the rate at which people buy things, the rate at which companies invest, that shock is going to be much worse in terms of what's going to happen this quarter and probably next quarter than 2008. And, you know, we're talking multiples of what happened in 2008. The question is, how long will this shock persist? And if dysfunction in the financial system will then lead to a longer period of less than satisfactory growth, which is what we saw after 2008. But the policy response we're seeing this time is very different. We are seeing governments like the UK government step in and offer an element of insurance to businesses. They're going to pay wages, they're going to make credit available, and they've done this very quickly. On top of that, we are seeing macro level fiscal stimulus very quickly, more than in 2008. And of course, we've seen the banks immediately ease monetary conditions in a very, very aggressive attempt to prevent a financial crisis from developing. So even though the initial shock is likely to be much worse than 2008, we can at least keep our fingers crossed that the aggressive policy action we've seen means that the recovery will be much more satisfactory. I think the final point to add is that the global policy space is going to look very different after this. We have a conservative government that's effectively buried some 30 or 40 years of policy consensus in the UK. And so in the future, perhaps governments will be not satisfied with, for example, a decade of very low wage growth like what we saw in the UK.
And Lukman Otunuga, what do you think? Is it comparable to the 2008 situation? And if not, why not?
Right now, how things are looking, it's especially if you look at major institutions, the IMF now expects a recession worse than the one in 2008, and even the Organization of Economic Cooperation and Development has warned that economic growth, global growth, could actually halve to roughly 1.5% in 2020. I think the major difference between what we're seeing, this Black Swan event, now compared to the 2008 financial crisis, is the coronavirus is a health pandemic. It's something that has displayed a strong level of resilience against, you know, the explosive levels of fiscal policies from governments, fiscal policies from central banks, banks and governments. I think right now it's still quite early to really determine how badly things are going to be, and we're going to have to wait for economic data to slowly feed through. But just to add to this, something's going to give and something's going to take. For example, I think containing the coronavirus may possibly trigger a global recession in the first half of 2020. The reason I'm saying this is because if you look at all the strategies that have been put in place, especially the UK lockdown, the lockdowns across the world, consumption is going to drop, and consumption is a major engine of growth for a lot of economies. So if we have a situation where consumption is dropping, naturally the negative impacts are going to feed back into GDP.
Absolutely, because I mentioned earlier consumer spending, and people just aren't leaving their homes, they aren't spending as much money. How is the economy going to make up for that? Presumably it can't, it needs to find another way.
I think just if I can just add something to that and I'll answer that question. I think if we look back in 2008, the crisis was very much focused on the financial industry. It did have knock-on effects to other industries at that time, but mainly the challenge was in the financial industry. If you look at this financial crisis caused by this pandemic, it's everyone. It's literally everyone. I've spoken to opticians, pharmacists, financial companies. Everyone is being impacted by this. And I think one key thing to think about, I run another business which manufactures products in China, and China is back up and running from a supply perspective. So the factories are almost at full capacity now. They're steaming ahead. But if the demand side, our side, doesn't pick up, that's going to have a massive impact on China as well. Now, if we start to see that impact across the world, I mean, we're definitely heading to a much deeper recession than what we saw in 2008, and hence the importance of everyone just listening to governments and staying at home, staying away from other people. A government being able to isolate the virus in whatever way they can.
Let's explore the theme of China then a little. Obviously, a huge economy. It's already faced the coronavirus and is potentially emerging the other side. But can its economy, which is such a strong driver, recover when the Western economies are in decline?
Yeah, I think that's really the question, because the Chinese economy is still reliant on external demand to a great extent, despite a lot of efforts to attempt to reorientate it away from investment and export-led growth and towards domestic consumption. They still rely a lot on exporting to the rest of the world, and we're about to see the biggest demand shock to the rest of the world again in at least since the Second World War. So I think even though the initial signs from places like China and South Korea are encouraging, in that if you implement very aggressive containment measures, you can bring the health crisis under control. It is not clear at this point whether or not we will now see infection rates begin to pick up again in China, and therefore we don't know how long this rolling shock to the global economy is going to last. And the problem is that because of the extent to which the global economy is interlinked, the extent to which supply chains are integrated, demand chains are integrated, if you have large regions that are shut down, then that's going to impact growth as a whole. So potentially we are looking at a rolling crisis that will last several quarters and will be quite deep indeed.
What do you think, Lukman? Again, I saw you nodding.
Yeah, just to add to what Ranko said, China makes up a third of manufacturing globally, and it's the world's largest exporters of goods. And as we can see, a lot of economies have strong trade ties and are quite interlinked to China. And this negative shock is something we are going to see in 2020, especially with many emerging market economies. For example, if you just look at oil prices is one of the biggest casualties of the coronavirus outbreak. Oil has tumbled a painful 60% since the start of the year, thanks to concerns over a falling demand from the largest energy consumer, which is China. And this knock-on effect is most likely going to hit emerging market energy producers. And this is just one example of many. So yes, China is looking like it may recover. I think it's too early to say that. But even though the coronavirus, or in the best of worlds, if we have a situation where the coronavirus outbreak is contained and the death toll continues to fall, I think the impacts are going to be, the economic impacts are going to be felt throughout 2020.
And clearly we are dealing with so many uncertainties here, but let me just ask you the $10,000 question, which is what will it take to bring us out of this, and when might we see that happen?
There's that old saying that there's no atheists in a foxhole. I think at the moment, there's no libertarians in a crisis. So this is not something you can kind of leave the market to sort out. Clearly, we need aggressive policy action, both public health policy action. We need fiscal policy action to keep businesses open, to mitigate the damage, and to stop, I guess, the destruction of all of these complex growth systems that have developed over decades and decades. And then finally, we need massive, massive monetary expansion. So really, a lot of that is, we're talking about government mechanisms. The market's not going to sort this out.
Okay, Lukman, what do you think?
Ranko always beats me to it. Yeah, so literally, we need aggressive monetary policy, even though we've said that monetary policy has limited impacts on this health crisis, more aggressive fiscal policies. But really, the answer to this $1 million question is a cure. I believe if we do have a cure, if there's signs that a cure is on its way, the improvement in business sentiment and overall investor confidence should support financial markets.
Okay, gentlemen, we are out of time. Thank you so much indeed for being with us at the Roundtable. Asad Hamir, Lukman Otunuga, and Ranko Berich. Thank you very much indeed. Well, thanks again to our guests. Remember, you can see more discussion and debate on our YouTube channel. Search for TRT World Roundtable. But for now, from me and all the team here, goodbye and thank you for watching.